1 quadrillion, $100 trillion. That's 1 followed by 15 zeros. Written out, it looks like this. $100,000. And that's the estimated notional value of the global derivatives market right now. Not stocks, not bonds, not the money in your bank account. Derivatives. Financial contracts that most people have never heard of, built on top of other financial instruments, creating a shadow financial system that dwarfs the entire global economy. For perspective, the entire world's GDP is roughly $100 trillion. The total value of every stock market on Earth is around $110 trillion. All the real estate in the world, approximately $330 trillion. The derivatives market is potentially 10 times larger than all of those combined. And if you think that number is too abstract to affect your daily life, I need you to understand something critical. In 2008, it wasn't bad mortgages that nearly destroyed the global financial system. It was derivatives, specifically credit default swaps, contracts that most Americans had never heard of until suddenly they were being asked to bail out the banks that created them. What I'm about to show you is not speculation. This is Bank for International Settlements data, Federal Reserve documentation, SEC filings, numbers compiled by the institutions that regulate these markets, all publicly available, all verifiable. There's a pattern here, a pattern of how financial systems become dangerously overleveraged, how risk gets hidden in complex instruments, and how the unwinding happens faster than anyone expects. This pattern has played out before, multiple times, and the warning signs appearing now are nearly identical to what preceded previous crises. By the end of this video, you'll understand what derivatives actually are, why they've grown to such incomprehensible size, what triggers their unraveling, and what it means for your savings, your retirement, and your financial future. The next 19 minutes will change how you understand the financial system forever. Welcome to the silent economy. Before we go any further, let me explain what derivatives actually are, because understanding this is essential to understanding the risk. A derivative is a financial contract whose value is derived from something else. That something else could be a stock, a bond, a commodity, an interest rate, a currency, or even another derivative. Here's a simple example. You buy a contract that pays you money if the price of oil goes above $80 per barrel by December. You don't own any oil. You just own a contract that references the price of oil. That's a derivative. Now, there's nothing inherently wrong with derivatives. They serve legitimate purposes. Airlines use them to lock in fuel prices. Farmers use them to guarantee crop prices before harvest. Companies use them to protect against currency fluctuations. These are called hedging activities, managing real business risks with financial contracts. Perfectly sensible. But here's where it gets dangerous. Derivatives can also be used for pure speculation. You don't need to own the underlying asset. You don't need any connection to it whatsoever. You can simply bet on price movements with enormous leverage. And when I say enormous, I mean you can control $100 worth of exposure with just $1 of actual capital, sometimes more. This creates a multiplication effect. The global GDP is around $100 trillion. That's the actual economic output of every country combined. But the derivatives market, by some estimates, represents over $1 quadrillion in notional exposure. How is that possible? Because derivatives can be stacked on top of each other. You can create a derivative based on a basket of stocks, then create another derivative based on that derivative, then another based on that, each layer multiplying the notional value while requiring relatively little actual capital. The Bank for International Settlements, which tracks these markets, reported over $632 trillion in over-the-counter derivatives alone as of their latest data. Add exchange-traded derivatives, and estimates climb much higher. But here's the critical insight. Notional value isn't the same as actual risk. The actual money at risk is much smaller. The BIS estimates gross market value of these derivatives at around $18 trillion. Still massive, but not 1 quadrillion. So why does the larger number matter? Because of counterparty risk. Every derivative contract has two sides. If one side fails, it can trigger failures down the chain. And when you have $1 quadrillion in interconnected contracts, even a small percentage of failures can cascade into a systemic crisis. This isn't theory, it's happened before. Let me show you exactly how this pattern is played out. Example 1. Long-term capital management, 1998. A group of traders and academics, including 2 Nobel Prize winners, launch a hedge fund called Long-Term Capital Management, LTCM. Their strategy uses complex mathematical models to identify tiny price discrepancies between related securities. The profits on each trade are minuscule, but they use enormous leverage to multiply those tiny profits into substantial returns. How much leverage? At its peak, LTCM had about $5 billion in investor capital, but they controlled positions worth over $125 billion, and their derivatives exposure reached over $1 trillion in notional value. For every dollar of actual capital, they had over $200 of exposure, perhaps more. For 4 years, it worked beautifully. Returns of 21%, 43%, 41%. Investors thought they'd discovered a money machine. The smartest people in finance, validated by Nobel Prizes, using mathematics to eliminate risk. Then came 1998. Russia defaulted on its debt. Market correlations that LTCM's models assumed would remain stable suddenly shifted. Positions that were supposed to move in opposite directions started moving together, against them. In a matter of weeks, LTCM lost nearly all of its capital. Their positions were so large and so interconnected with major banks that the Federal Reserve had to coordinate an emergency bailout. Not a government bailout, a private bailout organized by the Fed. 14 major banks contributed $3.6 billion to prevent LTCM's collapse from triggering a systemic crisis. Why? Because LTCM's derivatives contracts were with every major bank on Wall Street. If LTCM failed and couldn't honor its contracts, those banks would face billions in losses, which could cause them to fail, which could bring down the entire system. The lesson? Complex, leveraged derivatives can amplify small market moves into existential threats. An interconnection means failure doesn't stay contained. But the financial system didn't learn this lesson. It repeated the same pattern on a much larger scale. Example 2, the 2008 financial crisis. By 2007, the derivatives market had exploded. Credit default swaps alone had grown from essentially zero in the 1990s to over $60 trillion in notional value. What's a credit default swap? Essentially, insurance on debt. If you own a bond and you're worried the borrower might default, you can buy a credit default swap. If default happens, the swap pays you. Sounds reasonable. But here's the problem. Unlike traditional insurance, you didn't need to own the underlying bond. Anyone could buy a credit default swap on any debt. You could buy insurance on a house you didn't own. You could buy 10 policies on the same house. This meant the credit default swap market grew far larger than the actual debt it referenced. There were more insurance contracts than things being insured. And who was selling these contracts? Major financial institutions. AIG alone had sold over $400 billion worth of credit default swaps on mortgage-related securities. When housing prices fell and mortgages started defaulting, AIG owed more money on its derivatives contracts than the company was worth. The entire company was effectively bankrupt. But AIG's failure wouldn't just affect AIG. Every major bank had bought credit default swaps from AIG. If AIG couldn't pay, those banks would face massive losses on contracts they thought were assets. The dominoes would fall. In September 2008, the Federal Reserve provided an $85 billion emergency loan to AIG, eventually expanded to over $180 billion, the largest bailout of a private company in history. And AIG was just one company. The entire financial system was riddled with similar interconnections. Derivatives, contracts totaling tens of trillions of dollars, all threatening to unravel simultaneously. The pattern repeated. Leverage, complexity, interconnection, small trigger, massive cascade. Example 3. The 2020 Treasury market disruption. March 2020, COVID-19 triggers a global panic. Stock markets crash. Investors flee to safety. Traditionally, when stocks crash, Treasury bonds rise. They're the safe haven, the place money goes during crises. But something strange happened in March 2020. Treasuries and stocks fell together. The safest assets in the world were selling off alongside the riskiest. The Treasury market, the deepest and most liquid market on Earth, started showing signs of stress. What was happening? Hedge funds had built up massive leveraged positions in Treasury markets, a strategy called the basis trade. They were exploiting tiny price differences between Treasury bonds and Treasury futures, using enormous leverage to profit. Sound familiar? When markets crashed, these funds faced margin calls they had to sell, all at the same time. The selling overwhelmed the market's ability to absorb it. The Federal Reserve had to intervene. They purchased over $1 trillion in treasuries in just 3 weeks. The largest and fastest intervention in history. Without it, the Treasury market might have frozen entirely. The Treasury market, the foundation of the global financial system, nearly broke because of leveraged derivatives strategies. And here's what's concerning. According to the Office of Financial Research and the Financial Stability Board, these same types of leveraged positions have since rebuilt. Some analysts believe they're now larger than they were in March 2020. The pattern keeps repeating. The leverage keeps building. The risks keep growing. So where are we now? Let me walk you through the current landscape. According to the Bank for International Settlements, the over-the-counter derivatives market totals over $632 trillion in notional value. Interest rate derivatives make up the majority at over $500 trillion. Credit derivatives, currency derivatives, commodity derivatives, and equity derivatives comprise the rest. The gross market value, meaning the actual money that would change hands if all contracts settled today, is around $18 trillion. That's the more relevant risk figure. But here's what matters. concentration, and interconnection. 5 American banks hold the vast majority of derivatives positions in the U.S. banking system. According to the Office of the Comptroller of the Currency, J.P. Morgan, Goldman Sachs, Citibank, Bank of America, and Wells Fargo together hold over $200 trillion in notional derivatives exposure. Yes, 5 banks, $200 trillion. These are the same banks that were at the center of the 2008 crisis. The same banks that were deemed too big to fail, they're now bigger. And their derivatives books are larger. Now, these banks will tell you the risk is managed. Positions are hedged. Net exposure is much smaller than notional value. And they're right, under normal conditions. But as we've seen in every previous crisis, conditions don't stay normal. Correlations break down. Counterparties fail. Hedges don't work as expected. What are the current pressure points analysts are watching? First, interest rate derivatives. When central banks raised rates at the fastest pace in decades, it created massive movements in interest rate markets. Banks with large positions in interest rate swaps faced significant mark-to-market adjustments. Some regional banks failed in part due to interest rate exposure, though not primarily derivatives. Second, the commercial real estate market. Vacancy rates in office buildings are at historic highs in many cities. If commercial real estate values decline significantly, credit derivatives linked to commercial mortgage-backed securities could face stress. This was a significant factor in 2008, and the concerns are resurfacing. Third, sovereign debt. Global government debt has reached record levels. Japan's debt exceeds 260% of GDP. Several European countries are above 100%. The US is at roughly 120%. Credit derivatives linked to sovereign debt could face stress if any major country experiences a debt crisis. Fourth, the shadow banking system. Hedge funds, private credit, private equity. These entities are less regulated than banks and have grown enormously. They hold significant derivatives positions but face less scrutiny. The Financial Stability Board has repeatedly warned about vulnerabilities in non-bank financial intermediation. Their reports highlight leverage, liquidity mismatches, and interconnection with the traditional banking system. Now, I want to be very clear about something. None of this means a crisis is imminent. None of this means collapse is inevitable. The financial system has safeguards that didn't exist before 2008. Capital requirements are higher. Stress testing is more rigorous. Some derivatives are now cleared through central counterparties, reducing bilateral risk. But the fundamental dynamics that caused previous crises haven't disappeared. They've evolved. Leverage still builds. Complexity still obscures risk. Interconnection still creates contagion paths. The question isn't whether these vulnerabilities exist. They clearly do, documented by regulatory agencies themselves. The question is whether the safeguards are sufficient when the next shock arrives. History suggests we should be humble about our ability to predict and contain these events. Now, I can anticipate some objections. Regulators have fixed the problem since 2008. Dodd-Frank, Basel III, central clearing. The system is safer now. There's truth to this. Significant reforms were implemented. Banks hold more capital. Derivatives are more transparent. Stress tests are regular occurrences. But consider this. Every major crisis happened in a system that regulators believed was safe. In 2006, Federal Reserve Chairman Ben Bernanke said the housing market would likely experience a soft landing. In 1998, LTCM's risk models showed their strategies were virtually risk-free. Regulatory frameworks are designed to prevent the last crisis, not the next one. And financial innovation consistently finds ways around existing rules. The growth of private credit, the complexity of new derivative structures, the rise of cryptocurrency-related financial products. These represent new territories that existing regulations may not adequately address. But the numbers are exaggerated. Notional value isn't real risk. This is correct. Notional value overstates actual exposure dramatically. Most derivatives offset each other. Net positions are much smaller. However, netting only works when counterparties can meet their obligations. In a crisis, when multiple counterparties fail simultaneously, those netted positions become gross positions very quickly. And $18 trillion in gross market value is still enormous. It's larger than the GDP of every country except the United States and China. Smart people are managing these risks. They understand the dangers. Smart people were managing LTCM. 2 Nobel laureates, the most sophisticated models in finance. They still nearly brought down the financial system. Smart people were managing risk at AIG, at Bear Stearns, at Lehman Brothers. Intelligence doesn't prevent systemic risk. Sometimes it enables it by creating complexity that obscures dangers until it's too late. The point isn't to predict a specific crisis. It's to understand that the conditions for crisis exist, documented by the very institutions responsible for preventing them. So what does this mean for ordinary people trying to protect their financial future? First, understand that the system has inherent fragilities. This doesn't mean panic. It means awareness. The financial system is not a neutral backdrop to your life. It's a complex machine with potential failure modes. Second, diversification matters more than ever. If your entire financial life is concentrated in one asset class, one currency, one geographic region, you're exposed to systemic risks you can't control. Spread your exposure across different types of assets in different jurisdictions, where appropriate. Third, understand what you own. Many investment products contain derivatives, exposure you might not realize. Read the documentation. Understand the counterparty risks. Know what happens in various scenarios. Fourth, maintain liquidity. In every financial crisis, liquidity becomes precious. Having accessible cash or equivalents provides options when markets freeze. Don't be forced to sell at the worst possible moment because you need immediate access to funds. Fifth, reduce unnecessary leverage. If major financial institutions can be destroyed by leverage, so can households. High personal debt in a volatile environment creates vulnerability you don't need. Sixth, stay informed but maintain perspective. Understanding risks doesn't mean living in fear. It means making better decisions. The financial system has survived previous crises and will likely survive future ones, but the path through crises is painful for those who aren't prepared. Seventh, consider professional guidance. These are complex topics. A qualified financial advisor who understands systemic risks can help you structure your personal situation appropriately. Don't rely solely on any YouTube video, including this one. Approximate? Runtime, 1930. 20? This is the silent economy. We don't chase clicks with baseless predictions. We analyze the structures underneath the financial system that mainstream coverage often ignores, the patterns that reveal how markets actually function. If this analysis was valuable, if it helped you understand something about the financial world you didn't before, subscribe and hit the notification bell. Because next week, we're breaking down how central bank policies have reshaped the relationship between risk and reward in ways most investors don't understand, and how to think about positioning in a world where traditional rules may no longer apply. Drop a comment below. Tell me your thoughts on derivatives market risk. What are you seeing in your own financial life? What questions do you have? I read and respond to comments. The financial system is complex, but complexity doesn't mean incomprehensible. There are patterns, there's logic, there are warning signs that appear before crises unfold. Your job is to see them. Thanks for watching. This is The Silent Economy, and we'll see you in the next one.